I've spent most of my life watching people make the same mistake over and over again. It's not that they're unintelligent. Most of them are quite bright, actually. And it's not that they lack ambition or drive. They have plenty of that too. The mistake is simpler than you'd think. They try to beat time instead of using it. I've seen this play out thousands of times now. Someone finds a good investment, something genuinely solid, with real earnings and a sensible future. And then, after 3 months, they get restless. After 6 months, they start wondering if there's something better. After a year, they've moved on entirely, searching for the next thing that will deliver faster. And in doing so, they've walked away from the very force that would have made them wealthy, time. Now, I know that sounds almost too simple. We live in a world that celebrates speed, quick wins, fast money, overnight success stories. And I understand the appeal of that. I really do. We're wired to want results now, not later. Our brains didn't evolve to think in decades. They evolved to think in days. But here's what I've learned, and it's taken me a lifetime to see it clearly. Time doesn't just help good investments. Time is the investment. Let me explain what I mean by that. When you buy a share of a good business, you're not really buying a piece of paper or a number on a screen. You're buying a claim on future earnings. And those earnings don't happen all at once. They accumulate month after month, year after year. They build on themselves. This is compounding. And compounding is the closest thing to magic that exists in finance. But here's the part most people miss. Compounding doesn't really show up in year 1. It barely whispers in year 2. In year 3, you might notice it if you're paying attention. But by year 10, year 20, year 30, it's roaring. And that's exactly when most people aren't around to hear it. They left in year 2 because they got bored, or they sold in year 5 because they got scared, or they moved everything around in year 7 because they read something that made them doubt themselves. I'm not judging that impulse, by the way. I understand it. Fear is real. Doubt is real. Impatience is deeply human. But understanding something doesn't make it profitable. Let me tell you what I've seen happen to people who learn to sit still. They start with a modest amount. Maybe they invest in a business that grows its earnings by 10 or 12% a year. Nothing flashy, nothing that makes headlines, just a steady, reliable compounder. In the first few years, it feels like not much is happening. The account grows a little, the earnings tick up, but nothing life-changing occurs. Then something interesting starts to happen around year 7 or 8. The growth that felt slow in the beginning starts to feel a little more noticeable. The numbers get bigger, not because the percentage changed, but because the base got larger. By year 15, they're often surprised at how much the position is worth. Not because anything dramatic happened, but because small, consistent growth left alone becomes large. By year 20 to 5 or 30, they're often astonished. The original investment has multiplied many times over, and the annual earnings from that one position might now exceed what they originally put in. That's not luck. That's not timing. That's just math allowed to run. But here's the hard part. To get that result, you have to do almost nothing. And doing nothing is one of the hardest things in the world, because the world will not leave you alone. Every day, someone will tell you about a stock that's up 30% this month. Every week, there will be news that makes you question what you own. Every quarter, there will be a dip, a stumble, a reason to worry, and your brain, which is trying to protect you, will whisper that maybe you should do something, move the money, sell this, buy that, stay active, stay alert. But activity is not the same as progress. In fact, in investing, activity is often the enemy of progress. I've seen people trade themselves into oblivion, not because they were dumb, but because they couldn't sit still. Every trade felt rational in the moment. Every move seemed justified. But the cumulative effect of all that motion was to interrupt compounding again and again and again. And once you interrupt compounding, you have to start over. You reset the clock, and you lose the most valuable years, which are always the later ones. Now, I want to be clear about something. I'm not saying you should buy anything and hold it forever no matter what. That would be foolish. Businesses change. Industries change. Sometimes you make a mistake and you need to correct it. What I am saying is this. If you own a good business run by honest and capable people, earning solid returns on capital, and growing steadily, your default position should be to do nothing. Not because doing nothing is easy, but because doing nothing is usually right. The question you should ask yourself is not, what should I do? The question should be, what problem am I solving by acting? If the business is still good and the price is still reasonable and nothing fundamental has changed, then action is usually just noise disguised as decision-making. Let me give you an example from my own experience. Decades ago, I bought into a business that seemed quite simple. It had a strong brand. It had loyal customers. It earned good returns. And it was run by people I trusted. For years, nothing dramatic happened. The business grew, but not spectacularly. The stock went up some years, down others. There were moments when it looked expensive, moments when it looked cheap, moments when the news was good and moments when the news was troubling. And through all of that, I did very little. I didn't sell when it dipped. I didn't sell when it soared. I just held on because the underlying business kept doing what I expected it to do. Today, that position is worth many, many times what I paid for it. Not because I was smart, not because I timed anything, but because I let time do the work. That's what I mean when I say time is a better investor than most people. Time doesn't panic. Time doesn't get bored. Time doesn't check the price every day and feel anxious. Time just moves forward quietly and steadily, allowing good businesses to compound. Now, I realize this approach doesn't sound exciting, and that's part of the problem. We've been conditioned to think that investing should feel exciting, that if you're not actively doing something, you're falling behind. But the truth is the opposite. The people who are constantly doing something are usually the ones falling behind. They're paying taxes on short-term gains. They're paying trading fees. They're making decisions based on incomplete information and emotional reactions. And most importantly, they're robbing themselves of compounding. The people who do well, the ones who build real wealth over a lifetime, are often the ones who look like they're doing the least. They find something good. They buy it at a fair price, and then they go live their lives. They don't obsess. They don't trade. They don't refresh their portfolio balance every hour. They just let the business do what good businesses do, which is grow. And in 20 or 30 years, they wake up wealthy, not because they were geniuses, but because they patient. Patience, though, is not the same as passivity. This is important. Being patient doesn't mean ignoring what you own. It doesn't mean closing your eyes and hoping for the best. It means staying informed without being reactive. It means understanding the difference between noise and signal. Most of what happens in the market is noise. Prices bounce around, headlines come and go, analysts change their minds. None of that matters much if the underlying business is still sound. What matters is whether the company is still earning money, whether it's still growing, whether management is still allocating capital wisely, whether the competitive position is still strong. Those are the questions worth asking, not what's the stock price today, not what did some analyst say this morning, but is this still a good business? If the answer is yes, then doing nothing is often the smartest move you can make. Now, let's talk about the other side of this, the psychological side, because knowing what to do and actually doing it are two very different things. The reason most people can't sit still is not that they lack information, it's that they lack emotional discipline. Investing is not hard because the math is complicated. It's hard because it requires you to act against your instincts. Your instincts tell you to run when things feel scary. Your instincts tell you to chase when things feel exciting. Your instincts tell you to do something, anything, when you're uncertain. And all of those instincts, while useful in other parts of life, are destructive in investing. The person who can override those instincts has an enormous advantage. Not because they're smarter, but because they're calmer. Calmness is an edge. Maybe the biggest edge there is because when everyone else is panicking, the calm person can think clearly. When everyone else is euphoric, a calm person can stay skeptical. When everyone else is trading frantically, the calm person can sit still. And over time, that calmness compounds just like returns do. I think one of the reasons people struggle with this is that they confuse activity with competence. They think that if they're not doing something, they're not being responsible, they're not being diligent. But in investing, diligence often looks like restraint. It looks like discipline. It looks like the ability to watch something you own drop 20% and not sell because you understand that price and value are not the same thing. That's not easy. In fact, it's agonizing, but it's also necessary because if you can't tolerate short-term volatility, you'll never capture long-term returns. The two come as a package. You can't have one without the other. People often ask me, how do you know when to sell? And my answer is usually unsatisfying to them, because the truth is, I don't think about selling very often. If I've done my job right on the front end, if I've bought something good at a fair price, then there's rarely a good reason to sell. The business might stumble for a quarter or a year, the stock might lag, but as long as the core thesis is intact, selling just resets the clock. The times I do sell are when something fundamental has changed, when the management has lost its way, when the competitive position has eroded, when the economics of the business have shifted in a way that can't be reversed. But those moments are rare, much rarer than most people think. Most of the time, the right move is to do nothing, and the hardest part of investing is accepting that. Let me tell you about one more thing I've noticed over the years, something subtle but important. The people who succeed at this, the ones who really build wealth through patience and compounding, tend to have something in common. They don't need the money right now. That might sound obvious, but it's worth sitting with for a moment. If you need the money you've invested in the next year or two or even 5, then you can't afford to be patient. You're at the mercy of short-term price movements. You have to sell when you need cash, regardless of whether it's a good time to sell. But if you don't need the money, if you're investing for 10 or 20 or 30 years down the road, then you have time on your side. You can ride out the dips. You can ignore the noise. You can let compounding do its work. This is why I've always said you should never invest money you can't afford to lose or that you'll need soon. Not because you're going to lose it, but because having that need creates pressure, and pressure leads to bad decisions. The best investing happens when there's no urgency, when you can afford to wait, when you can let time pass without anxiety. That's when compounding really shines. Now, I want to address something that might be on your mind. You might be thinking, this all sounds good in theory, but what about the people who got rich quickly? What about the people who timed the market perfectly or picked the next big thing? And yes, those people exist. I'm not going to pretend they don't, but here's what I've learned. For every person who got rich quickly, there are 100 who tried the same thing and lost money. You just don't hear about them. The problem with chasing quick gains is not that it never works, it's that it rarely works. And when it doesn't work, it's catastrophic. Whereas the slow, steady approach, the one built on patience and compounding, works far more often. It's not flashy. It won't make you rich overnight, but it will, over time, build real, lasting wealth. And here's the thing. The people who got rich quickly often don't stay rich, because the skills that allow you to make money fast are not the same skills that allow you to keep it. Patience, on the other hand, serves you in both directions. It helps you build wealth and it helps you preserve it. So if you're asking me which path I'd recommend, it's not even close. Slow and steady wins, not sometimes, almost always. There's another aspect to this that I think is worth exploring, and it has to do with what we pay attention to. Most people pay attention to price. They watch the ticker. They check their accounts. They feel good when things are up and anxious when things are down. But price in the short term is almost meaningless. It's just a number that reflects what someone else is willing to pay today. And that person might be informed, or they might be panicking, they might be rational, or they might be caught up in a frenzy. The price tells you very little about the actual value of what you own. Value is different. Value is what the business is worth based on what it can earn over time. And value doesn't change much from day to day or even month to month. A good business earning solid returns this year will likely be earning solid returns next year. The price might swing wildly in between, but the value stays relatively stable. The investor who focuses on value instead of price has a huge advantage, because they're not distracted by the constant noise of the market. They're looking at the fundamentals, the earnings, the competitive position, the quality of management. And when you focus on those things, the day-to-day price movements stop mattering so much. You start to see drops in price as opportunities, not disasters. You start to see volatility as normal, not threatening. You start to understand that what looks like chaos in the short term is just part of the process. This shift in perspective is everything, because once you stop reacting to price and start thinking about value, you can finally be patient. And patience, as I keep saying, is where the money is made. I also want to talk about what happens when things go wrong, because they will. If you invest long enough, you will own something that disappoints you. Maybe the business doesn't grow as fast as you hoped. Maybe management makes a mistake. Maybe the industry changes in a way you didn't anticipate. This is normal. It happens to everyone. The question is, what do you do when it happens? The knee-jerk reaction is to sell, to admit defeat and move on. And sometimes that's the right move. But more often than not, it's the wrong one. Because most problems are temporary. Most stumbles are recoverable. And if you sell every time something goes wrong, you're guaranteeing that you'll never be there for the recovery. I've made this mistake myself more times than I'd like to admit. I've sold things that I should have held. And in almost every case, it was because I let short-term disappointment override long-term thinking. What I've learned is to ask a different question when things go wrong. Not should I sell, but has the long-term thesis changed? If the answer is no, if the business is still fundamentally sound and just going through a rough patch, then holding is usually the right move. If the answer is yes, if something is fundamentally broken, then selling makes sense. But that distinction is critical. Most of the time, the answer is no. The thesis hasn't changed. The business is still good. And selling would just be a mistake driven by emotion. So I sit, I wait. I give the business time to work through whatever issue it's facing, and more often than not, it does. That's the advantage of investing in good businesses. They're resilient. They have the ability to adapt and recover. And if you give them time, they usually do. Let me say something else about time that I think gets overlooked. Time doesn't just grow your wealth. It also reduces your risk. This sounds counterintuitive. We're taught to think that the longer you hold something, the more risk you're taking. But that's backwards. In the short term, anything can happen. Prices can swing wildly. Markets can crash. Businesses can stumble. All of that creates risk if you might need to sell soon. But over the long term, those short-term fluctuations matter less and less. The underlying value of the business becomes more and more apparent. And if you've chosen well, that value goes up. So the longer you hold a good business, the safer your investment becomes. Not riskier, safer. This is one of the great paradoxes of investing. What feels risky in the short term, the volatility and uncertainty, is actually what makes long-term investing safe. Because those short-term swings scare away most people. They create opportunity for those who can see past them. And they allow time to work its magic. If everyone understood this, everyone would be patient. But most people don't understand it, and so they trade and react and interrupt compounding. And in doing so, they hand the advantage to those who can wait. I think if there's one idea I'd want you to take from this, it's this. Time is not a constraint, it's an asset. The years ahead of you are not something to fear or rush through. They're the very thing that will make you successful if you let them. But you have to be willing to do something very difficult. You have to be willing to wait, to sit still, to trust that good businesses left alone will compound. And you have to be willing to ignore almost everything else. The news, the predictions, the hot tips, the daily price movements, all of it is noise. What matters is whether you own good businesses and whether you're GI. Giving them enough time to do what they do. That's it. That's the whole strategy. It's not complicated, but it's not easy either, because it requires you to go against the grain, to ignore your instincts, to resist the urge to act when everyone around you is acting. It requires you to believe that time, not effort, is the real driver of returns. And if you can do that, if you can truly internalize that and live by it, then I think you'll be just fine. You won't get rich overnight. You won't have exciting stories to tell at parties. You won't beat the market every year. But in 20 or 30 years, you will look back and realize something. You didn't need to beat the market. You just needed to let time work for you. And it did. The wealth you built won't feel like luck. It won't feel like genius. It will feel like the natural result of doing something simple and repeating it for a very long time. That's the power of compounding. That's the power of patience. That's the power of letting time be your partner instead of your enemy. And once you understand that, really understand it, investing stops being stressful. It stops being a game you have to win every day. It becomes something quieter, something steadier, something you can live with for decades without losing sleep. That, to me, is the real goal. Not just wealth, but peace of mind. The confidence that comes from knowing you've done the right thing and given it enough time to work. So if you take nothing else from this, take this, be patient, own good things, and let time do the rest. It's worked for me, and I believe it will work for you too.